Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
Welcome back to our mini-series on paying less in taxes in retirement with Roth Strategies. I'm your host, Rick Durkee, president and founder of the Coastal Financial Planning Group and host of Navigating Retirement. Thanks for joining us today. Let's conclude our discussion today on Roth accounts, how to control taxes, paying less in taxes in retirement, and let's review a little bit about what we've learned over this series of Roth strategies. Now, in this video series, we've talked about what a Roth is, the advantages of Roths, the differences in contributions and conversions. That's an important one that you definitely want to read back through or look back through these episodes, get more information on that. We've identified where each is utilized and strategies for each of those contribution strategies or conversion strategies. And we've talked about how you can take advantage of these Roth strategies. We've also discussed that we want to handle future taxation properly and the assumptions about taxes when you save money for the future. We also talked about the possibility that taxes are pretty much on sale right now and that we might want to take advantage of that. But we also did say on the other side how that could change. And also that right now might be the moment that we want to take advantage of the current low tax rate environment. Opportunity is knocking. We want to open the door for that opportunity right here and now. Now, how do you do that? Well, I'd like to subtly remind you that at the Coastal Financial Planning Group, we also do offer complimentary retirement tax analysis scenarios, taking you all the way through retirement. So before we begin today's episode on Roth strategies, I'd like to remind you that I don't know, or nobody else does know, everything with 100% certainty regarding what the future of taxes look like for Americans. Certainly, I have an intuition, and many I talk with agree that it may be more likely that taxes go up versus down in the future. But here's what we've been taught and what we know. We have been taught that taxes will be lower in retirement, and we really should take a look at what that could affect in our future planning for retirement if taxes don't end up being lower in retirement. We know that tax rates have come down since many of us started saving in our 401ks or our retirement accounts. For many of us, we're also now making more money than when we started working, and we actually may be paying lower taxes now. Now, nowhere is it written in the tax code that automatically retirees will pay lower taxes in the future when they retire. Most retirees actually have less deductions in retirement. And remember, tax laws can change anytime. The tax laws were lowered in this past presidential cycle and Congress cycle, and they can always be changed with a vote. Now, if tax laws do reverse in the future and start climbing higher, it's likely going to affect those with larger account balances, and their income will be affected disproportionately. So even if taxes stay the same, as our account value grows over the time, then our bill on those taxes will grow with it. As we start transitioning into retirement or passing assets to our family, we're seeing more and more people paying a large tax bill because they were saving during their working career, and then they're surprised how much they actually owe. Paying a bill out of your retirement savings nest egg is certainly going to be more difficult than paying a bill out of your paycheck while you're still earning. Laws have already recently changed, like the Secure Act, making tax-deferred accounts more restrictive, less attractive, and likely a larger burden on our beneficiaries of those IRA accounts. Now, as far as this country's debt, the country currently has 26 trillion with a T debt. And if you add Social Security, Medicare, and Medicaid, that debt goes easily over $100 trillion. Today's debt, deficit, and ongoing spending all equate directly to the present and future value of taxes going up. Among all adults, the average American retirement account has about $60,000 saved. Those with more are likely to be included in tax initiative targeting, mainly the wealthy Americans. Now, I'd like to offer to help you. I can help you run several different hypothetical retirement and legacy tax scenarios. We can help you work with your current tax professional or ones that we work with to help you control and manage your taxes. We can show you in black, white, and red what your tax obligation looks like, could potentially look like, and what kind of savings you may realize by being proactive in your tax planning. Remember that the longer that you wait, the more your account value grows, the larger your tax bill is going to be, even if tax rates stay the same. And more likely, there's some amount of additional change in the rules, regulations, and limitations controlling your tax bill. The IRS understands the value of compounding. They want your tax-deferred account to grow. Taxes are a compulsory purchase. We're obligated to buy them. And at some point, sooner or later, like it or not. So let me offer one more solution that can help you plan for your retirement savings and help you to reduce your tax bill in retirement. If you'd like to take a proactive approach to understanding and making informed decisions about how to manage your retirement in regards to taxes, pick up the phone or click on the button on this video to be in touch with us now, and then set up a convenient time to meet with us in the future. Either way, we can begin this conversation and talk about the opportunity that you have. The door's open. Remember, opportunity knocks, and it may only knock for a short period of time. Don't miss this opportunity. The offer is free of charge. The taxes are due on your account, and they're not free. Remember, tax laws that allow for this opportunity could be changed at any time and closed in the future. So let's take advantage of this open door opportunity today. This is a critical decision that will help you determine one of your retirement's largest expenses, taxes. Remember, we know what taxes are today, and we can buy the IRS out of future tax rates. We can run this report that we have available for you and have made it available for so many others. Find out what your tax bill on your retirement accounts actually looks like. Contact us for a complimentary retirement tax analysis. We can make managing your taxes easy to manage.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.